Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. He is considered one of the top China experts among financial professionals. Emma Mollman, Kyle Bass, respect his work a lot. His incredible interview on Real Vision TV about China that was released in November 2019, entitled Dollar Liquidity Crisis, The Endgame for China, has over 200,000, almost 300,000 now views on Real Vision TV's YouTube channel. He is the managing principal and chief strategist at MacroLens LLC. Brian McCarthy, thank you for joining me.
Jason, thanks so much for having me today.
Now, Brian, before we get into the more sophisticated things about the Chinese economy and what's going on with the People's Bank of China and the Chinese banks, the Chinese economy, their credit, their shadow banking, wealth management products, local government finance vehicles, let's talk about how the Chinese economy has changed since 2008, 2009. So initially, what I heard, the narrative was that Chinese households had very little debt. They had a lot of savings. I think at one point it was 40% savings, that there was very little credit in the Chinese economy. So in your opinion, how has the Chinese economy changed since their enormous stimulus plan that they did in 2008 and 2009?
Sure. So there are a couple just different facets to this story, actually. You're right to identify the so-called 4 trillion stimulus package that China came to market with in 2009, widely hailed as, helping the global economy recover. They certainly did goose domestic demand quite aggressively, but it's a misnomer to call that a fiscal stimulus, and I don't really know where the number 4 trillion comes with. That was the sort of the overt central government fiscal component of it, but in fact, it was orders of magnitude larger than that. In the year 2009, year-on-year credit growth in China at one point hit 35%. So, I mean, it was just really an incredible monetary stimulus. And I would say as an aside, one thing your listeners want to keep in mind about policy in China is that there really isn't a fiscal policy. Okay, the vast majority of bonds that the government issues to finance a budget deficit are purchased by banks. And because banks are using ink money, expanding their balance sheet, basically creating money out of thin air to buy these assets, everything China does is effectively monetary policy. So I think the first thing to keep in mind about what they did in 2009, it was a massive monetary expansion. And 2009 was another important demarcation point for China because of the change in the external landscape. So as everybody knows, we had a financial crisis in 2008, recession in 2008, 2009, and we had a business cycle before that and a business cycle after that. And those two business cycles before and after the Great Recession in 08, 09 were actually very different in terms of their influence on China. And in short, the 2000s credit cycle globally was very clearly an inflationary boom. Monetary policy in the U.S. was very easy. Gold prices rallied like crazy 3 or 4 times throughout that cycle. Commodity prices boomed. Real estate prices everywhere boomed. And then, of course, that all crashed. And I think the important thing from my perspective, and this might be a non-consensus view, but the cycle from 2010 to 2020, call it, was a disinflationary cycle. It was not a monetary boom like the 2000s. Gold prices didn't go up. They went sideways. Commodities went lower over the 2010 cycle. Inflation undershot. Credit growth in the U.S. was actually the lowest in this past cycle of any post-war cycle. So these two cycles were very different globally, and I think this is a bit of an esoteric point, and maybe something a lot of your listeners might have a knee-jerk reaction to, because we've all been told that the Fed was blowing a bubble in the last 10 years, but there's really not a lot of evidence. And to bring the discussion back to China, the big difference between the two cycles is that Chinese FX reserves grew naturally in the 2000s and really up until about 2010. Their FX reserves grew quite naturally as a result of very easy liquidity conditions globally. That started to change with the global liquidity problems we had as a result of the European financial crisis in 2011, 2012. But it really changed dramatically in 2013 when the dollar started to strengthen and Chinese foreign exchange reserves went into reverse. Now, why is this important in the construct of what we're talking about is because when Chinese reserves are growing, because global liquidity is very easy and money is flowing into China, those reserves sit on the balance sheet of the People's Bank of China. It's effectively like a natural QE. So when the dollar's weak, liquidity is easy. China's currency wants to go up. They were intervening to prevent it from going up. They were buying U.S. treasuries on the balance sheet of the PBOC. They were doing QE effectively. PBOC balance sheet was growing, very easy for banks to extend lots of credit, and it's just a very easy situation for them to manage their, what has become, I think, the biggest credit bubble we've ever seen anywhere. When the dollar started to strengthen in 2013 to 2014, this changed dramatically for China, and they've been dealing with the fallout of this shift in global monetary policy ever since. So starting in 2014 in particular, Chinese reserves started to shrink. And as your listeners might know, they peaked at about 4 trillion, now running at 3 trillion. That is reverse QE. So this forces a monetary tightening on China, where the PBOC's balance sheet, at least in that natural sense of accumulation of FX reserves, started to shrink. And China has had a constraint on their ability to expand credit and keep their credit bubble from blowing up ever since. And this is the crux of a sort of a dilemma that the Chinese have been fighting for 5 or 6 years now. So you've got global monetary policy that is actually moderately tight. You know, commodity prices have not done well in the last 5 or 6 years. This puts pressure on the Chinese currency. The dollar is strong against everything. It's strong against the RMB. Other things equal, the PBOC is having to shrink its balance sheet, sell reserves to prop up the currency, and it makes it difficult for them to manage their monetary policy. Now, they've resorted to domestic QE by various means to make up for the shrinkage of the reserves. And we can get into whatever level of detail you'd like on how they've handled the shrinkage of reserves, but they've basically now told their corporates and their individual investors in China that they can't have access to dollars. They just can't buy dollars anymore because they have a problem in trying to maintain their exchange rate and at the same time keep credit conditions very, very easy in China. So, 2008 was really a demarcation point, in my view, for sort of global monetary policy, from one very genuinely inflationary boom period to a period in the last 10 years where any indicators of monetary policy would tell you it's actually been tight. And again, that's most important for China with regards to the U.S. dollar being strong and the tightness that forces in their monetary policy.
I want to ask you about China's foreign exchange reserve. So Kyle Bass has said publicly that he believes that the 3 trillion number that's stated everywhere is not the real number. He thinks it's at least 2 trillion or lower, falling quickly. Also, how much dollar-denominated debt has the Chinese economy accumulated? Because I've seen various estimates all over the place. And did that dollar-denominated debt, did that start during that time frame before the dollar started getting strong, or did China get desperate and start to accumulate dollar-denominated debt inside their economy afterward? The other thing that Kyle Bass has talked about extensively is these forward dollar swaps that increase in the Chinese economy. These are off-balance sheet items that the People's Bank of China ordered Chinese state-owned banks to do because they didn't want to drain their foreign exchange reserves. Is that correct?
Yes, so a lot to unpack there. Let me start with the dollar debt. So part of the RMB crisis in 2015 was because the dollar started strengthening. Chinese investors of all stripes started getting concerned about the possibility that the RMB might decline. Because they wanted to try to ease monetary policy, the PBOC wanted to remove this constraint of having to manage the exchange rate against a strong dollar, and they tried to wiggle out of the pegged exchange rate in August of 2015. And as your listeners might know, all manner of financial hell broke loose as a result. One of the problems that was caused there, that there were several $100 billion of dollar-denominated debt that Chinese corporates scrambled to pay down. So one of the big drains on reserves was the PBOC effectively having to fork over some of their dollars to the Chinese corporate sector so they could pay down the debt, because they were afraid that if the RMB declined, the value of that debt to them, denominated in dollars, was going to rise. Now, as you mentioned, out of necessity, that policy has been completely reversed, and probably, I don't know, 2017-ish, the Chinese authorities started to actually encourage Chinese corporates to rebuild that dollar debt, basically, and go borrow in dollars. Why did they do this? Because China is desperate for dollars. So any avenue they can use to access dollar liquidity that they can provide to companies and individuals in China who need dollars to transact or want dollars to diversify, they're doing anything they can. And one thing, when markets are in a benign mood and willing to lend money to Chinese property developers or other corporates, those corporate entities in China can borrow dollars on international markets, basically sell the dollars back into China to run their business, and that creates some inflow of dollars that helps relieve this problem. Of course, it just builds a problem that's going to come down the road at some point. We don't have good data on this. Like many aspects of trying to analyze China, there's guesswork involved. I think the BIS is something like 1.8 trillion. I would ballpark $2 trillion of this stuff, and that's dollar liabilities of Chinese corporates. So the reserves are $3 trillion. To your point about Kyle Bass's analysis, I generally agree. Let's call it benefit of the doubt, say there's $2 trillion that's liquid. So it's sort of an offset there. I mean, if you want to net that out, China's, net foreign currency position, I think is very weak, very weak. So, these are basically, robbing Peter to pay Paul, or, short-term needs overcoming, it's a can-kicking exercise, basically, to borrow these dollars now, bring the money back, and hope the liability can always be rolled and never gets called. As to the Chinese reserves, U.S. treasuries and agencies and U.S. equities that we can sort of see that some entities in China own, presumably the PBOC. But, if you look at the treasury tick data, it's not necessarily the PBOC. It's some entities in China. Presumably the PBOC own about $1.5 trillion in U.S. assets, probably a few $100 billion worth of European and Japanese assets. Call it $2 trillion, two and small change, against a headline figure of $3 and small change trillion in reserves. We know that there are substantial dollar-denominated, basically IOUs from other entities in China to PBOC as part of that $3 trillion. So there's a couple $100 billion that was used to seed CIC, the Sovereign Wealth Fund, 2003, I think it was, maybe it's 2007 actually. But at any rate, there's an IOU there where CIC says, "Hey, PBOC, we owe you $250 billion, say," and China. PBOC counts that as their reserves. It's not liquid. It's not accessible to them. There's no documentation on this, but I would speculate, I assume that Kyle Bass is doing a similar speculation in his calculation, that much of China's dollar-based lending through China Development Bank and other entities to Africa, Latin America, or to finance much of the Belt and Road was also funded out of the reserves. So the PBOC, again, they would have an IOU there from China Development Bank. China Development Bank owes PBOC dollars, and they have a dollar asset that might be in the form of a loan to Venezuela, right? That's not liquid. If you marked it to market, it wouldn't look too hot. So, the bottom line about the reserves, and, because there's no visibility, I'm speculating, Kyle Bass is speculating, we can debate this all day long. What we do know is that the Chinese government has effectively declared they don't have enough reserves to use them anymore, okay? Because 2 or 3 years ago, they changed their policy of fighting foreign exchange weakness with reserves and moved to this rationing policy, which I mentioned a moment ago. So they can try to hold up the currency by spending reserves. They realize they don't have sufficient reserves to do that anymore. So they simply tell the Chinese banks, don't give people access to dollars. So they basically tell the Chinese banks, whatever dollars come into the system, you can allocate those dollars out. Therefore, we will show a balanced account on our capital account where the dollars coming in will equal the dollars coming out. And it's not because the system is in equilibrium, it's because the state-owned banks have been told that they can only let out what comes in. So it's a forced result of balance, which, you know, again, this does not mean that this is a system in equilibrium. You know, they've taken a round peg and hammered it into a square hole effectively. But again, bottom line on the reserves is they don't have enough to use them anymore. So, you know, whatever is in there, it's sort of a moot point at this point because it's not a usable asset at this point in time.
Is this why, because they've drained their reserves too quickly, is this why they went to the forward dollar swaps? Because there's at least $1 trillion. I've heard estimates of even more than that. The Bank of International Settlements in December 2019 in their global macro update, they wrote over 24 pages warning about forward dollar swaps. They were very, very worried about this 4 or 5 months ago.
Sure. So I was extremely active in the Chinese foreign exchange market during this crisis period in 2015, 2016. I managed a hedge fund for a firm called Emerging Sovereign Group. It's called the Nexus Fund. It was predicated on a Chinese RMB devaluation. So we were right in the midst of this. I was getting estimates on from several banks on intervention activities by the PBOC, not only in the onshore market, but in the offshore CNH market. So the CNH market at that point was serving as effectively a huge porthole in their capital account. The money was flooding out by the hundreds of billions. The bottom line is China says their reserves went down by, call it $1 trillion, round number, over a 15-month period there in 2015 and 16. And if I tallied up, you know, what I think were really good estimates of what they were actually doing in the market, it was well over $1.5 trillion. So there was at least $0.5 trillion, if not $700 or $800 billion at that point, where we were wondering, like, if this didn't come from the reserves, if they didn't sell treasuries, where did these dollars come from? And it seems pretty clear that it came from borrowing by the PBOC in one of two forms. And I think they probably used both. So instead of selling treasuries to source dollars, we don't know whether or not they've borrowed against those treasuries. They could have repo agreements outstanding with any number of banks where instead of selling treasuries, they keep the treasury on balance sheet and there's an off-balance sheet. You know, the bond is collateralizing a repo borrowing in dollars. So they could have debits against their reserves in that form. And we know they were massively active in the foreign exchange swap market, where PBOC does an FX swap in the form of a buy and sale of dollars. So they buy dollars from, let's call HSBC, just to use a name. So the PBOC says, hey, HSBC, in 2 days you send me dollars, and then in a year I'll send them back. So PBOC gets the dollar spot in 2 days settlement. They sell them into the market to defend the currency, and then, you know, they're running the short position with HSBC or any number of other banks until it becomes time to roll. Now, to this point, they've been able to roll that. This is a debit against the reserves. But if at some point global banks say, we don't want to roll this position for you, you need to settle, then PBOC will have to sell treasuries to source dollars to settle those trades. Now, I'm not sure whether that's imminent, but what I do believe from my market contacts is that China's access to borrow more dollars versus these mechanisms is extremely limited. Okay, because the non-Chinese banks have a finite appetite for taking this credit risk and effectively lending the PBOC dollars. So it was a method for them to source dollars by borrowing and use that to defend the currency that I believe is no longer available to them. And it is possible, if there's some kind of geopolitical event or something that causes risk managers at global banks to say, I'm not really comfortable having PBOC owe me a couple $100 billion. Let's ask for some of that back. It could cause a problem. The other inflow that's been very beneficial to China in the last couple of years was, let's ballpark it, I would say 350 billion of passive investment funds from the rebalancing of the MSCI Global Equity Index, and more recently, the Bloomberg Barclays Global Bond Index have added China, increased the weighting to Chinese onshore assets fairly dramatically, which forces any asset manager or pension fund or whoever who benchmarks against these indices to increase their weighting to onshore Chinese assets. So let's call it 350 billion has been sent into China. Now, I think the Bloomberg Barclay reweighting will go through the end of this year, but I think any index company is going to be really reluctant to continue down that road of increasing the weighting to Chinese onshore assets because of both geopolitical risk and domestic risk in China. I think their investors are just really going to want to say, like, whoa, let's cool it on that routine for a while. Furthermore, that money could always come out. You could have a geopolitical kerfuffle where Marco Rubio puts pressure on MSCI to take China out of the index, or puts pressure on U.S. funds to reevaluate their holdings of Chinese assets. So this is another sort of a benefit that China has had in recent years that could go into reverse. So their capital account position is incredibly precarious. And back to where we started the conversation, in a strong dollar world, all these pressures are worse. They're more severe, right? If the dollar itself was to decline against everything, it would want to decline against the RMB as well, other things equal. So any analysis of the level of stress in China always has to keep in mind they're not the master of their own financial destiny. They have a peg. Soft peg, but reasonably firm lately, a peg to the US dollar. That means China's fate is going to, as long as they want to maintain that, is going to rest with the US dollar. Now, they could remove themselves from that constraint. They could have the dollar become immaterial to what they do if they floated the currency. But because of all this, vulnerability in their finances we've talked about, it would trade from 7 to 11 or something like that in fairly short order and unleash who knows what manner of instability in China. So they can't really do that. So it's just the Chinese system is in a disequilibrium that gets worse by the day. I think we're in a window in the next 12 to 18 months where there's a very good chance that things dislocate as a result of, what's happened globally.
Isn't there a lot of dollar-denominated debt inside the Chinese economy, and a lot of it is disproportionately concentrated in speculative real estate construction? Jim Chanos has said, depending upon how you measure it, about 25% of China's GDP now is in speculative real estate construction. We've seen Evergrande that their earnings were just announced in the last couple weeks, maybe a month, and it was down 50%. But we're starting to see cracks, whether it's Hong Kong real estate. Mainlanders are selling Hong Kong real estate, which worries me about HSBC Bank. HSBC Bank shares are down a lot in the last 6 weeks. So is the main collateral in China's economy with this credit bubble, this unbelievable amounts of credit growth that has been going on, as you described, is the main collateral higher real estate prices that could collapse this house of cards?
Sure. So Chinese policymakers, they can't live with the real estate bubble and they can't live without it. It's another in a long line of sort of pickles they've put themselves in. There are big social problems with continuing to let real estate prices rise. I mean, have what in China are upper middle class people who are spending 40, 50, 60% of their income on mortgage servicing. I mean, it's just not tenable for it to continue to rise. And it's not tenable for it not to continue to rise, because this is an asset that in most cases is generating no income and no utility. I mean, many of these apartments are empty. And so you're in a negative carry trade. And if that price isn't going up, who wants to be in that? So, Michael Pettis makes this point that, the Chinese property market actually needs to continue going up, or everybody's going to want to sell. You're not living in the unit. So if it's flat, you're losing money. So it's like, the old Woody Allen joke about relationships. A shark needs to keep moving forward or it dies. What we have here is a dead real estate market. Like they don't want it to go up. They don't want it to go down. And it's a huge problem. This also puts tremendous pressure on all of the problems that we've discussed to this point in our discussion, which is the property market is fueled by credit growth. If you look at the rate of change in credit growth in China, it lines up almost perfectly with the volume of real estate sales. When you grow credit by 30% in a year, your real estate prices are going to go up. So, and when they try to constrict credit, tight monetary policy, real estate wants to fall and they have to reverse. So just as an aside, credit growth in China last year was 11 or 12%. It's ticked up to 12 or 13%, call it now. So they haven't done any stimulus yet in response to this virus. But it has not, we haven't seen single digit credit growth since 2009 in China. So if they do not grow credit by double digits annually, the place blows up. I mean, it's observable. Now, outstanding credit, to use a round number, is $40 trillion. 10% is $4 trillion. If they want to do stimulus this year, you're talking $7 or $8 trillion of credit. Like, where is it going? What are they financing with that? A third airport in Beijing? This is the fundamental crux of their problem, is they have not been able to get off of the investment-led growth model. So the first airport in Beijing was a great investment. It's awesome. The second one, I don't know, maybe they'll break even. If they build a third one, it's going to be a huge money loser. So you can't continually goose the economy with credit-fueled infrastructure, because the ROI on the infrastructure naturally declines over time. And I would assert that it's, deeply negative at this point in any new project, most new projects they're doing. So, worse assets, a real estate bubble that requires lots of credit, no ability to have credit grow at anything less than a double-digit rate. And if anybody of your listeners are anticipating China actually doing something called stimulus this year, that's going to require credit growth closer to 20% than 10, and you're talking $7 or $8 trillion they will need to allocate. There isn't the opportunity for the Chinese system to take $7 or $8 trillion and invest it profitably. So if they do stimulus in this form, it's just making the problem worse. Unfortunately, I'm not sure Chinese real estate will crash, because from what I think I've learned about how the Communist Party operates, I think they're just going to rig the market. And I've already seen this firsthand in Erdos, which was really the first poster child ghost city. I was there in 2013 or 14, I believe it was. And it was the aftermath of this insane building boom, where they took a perfectly fine city and 40 kilometers down the road, they built another city and said, hey, let's have everybody move down there. And all the residents said, no, we're perfectly fine here. Why do we want to move to a new city when the city we have is perfectly fine? It sounds crazy, but that's what they did. So in this new city, everything's boarded up, but none of the banks were, showing any NPLs, and like what is going on here? And a couple of days of talking to people in the city, we realized what happened was the government just floored the real estate price. They said no one can sell below a level of X. I don't know, it was probably 12,000 RMB per square meter or something to guess. I don't remember. But they said below X, you cannot sell. So the prices didn't fall. The loans like kept getting rolled over. No one marked anything to market. And the problem was the assets became infinitely illiquid. You have a boarded up building that you say is worth 12,000 per square meter. No one wants to bid more than 4,000 per square meter. You can't ever sell it. So the entire city was sort of like balance sheet was okay, but everybody was broke because they had assets that everybody was pretending were still worth 3 times more than they actually were. So it doesn't actually solve the problem in any way, shape, or form. The people were still poor. It just wasn't being shown on paper. So my suspicion is that's probably already happening. And I suspect that that is the route they will take when they can no longer print sufficient credit at a fixed exchange rate to avoid having this real estate market collapse, which I presume it's doing right now behind whatever they're telling us the data is, frankly, given the dislocation in that economy. So they rig everything. This is the knee-jerk reaction of the Communist Party. It's stability and control at all costs. And, so again, think about how that dynamic plays out. If the Chinese real estate market to clear needs to fall by half, and they don't let anybody sell below, a price of par, then transactions will go to zero. Again, the assets become infinitely illiquid, and I guess they just play an elongated game of extend and pretend. But again, how long does that? I just don't know that that is even sustainable, because people will just do whatever they can to source liquidity and get it offshore in that scenario. So it's been a whack-a-mole game of market rigging, effectively, and I think what we're going to see next is the prices in the real estate market rigged by fiat.
Oh, that was an amazing explanation, Brian. Thank you so much. We've seen, there's a ton of videos and interviews on the China in Focus YouTube channel and many other sources, China Uncensored elsewhere, that there's really bad stagflation all over China now, with rent, with food prices, vegetables, pork. So this has been going on for a year with the African swine flu. The problems in the Chinese economy were pervasive throughout 2019. Look at all the different bailouts that happened. I mean, there was a bailout where China Construction Bank was ordered by the People's Bank of China and the Chinese government to bail out Hunan province for $300 billion. When I saw the press release, I couldn't believe what I was reading. And there were other weird and large bailouts similar to that throughout all of 2019, long before the coronavirus.
Yeah, so your listeners really need to appreciate what a weak position China was in going into this event, and how incredibly damaging it is for the Chinese economy. And furthermore, I would say how incredibly lackluster their policy response has been. I think China is going to lose a large swath of its SME sector as a result of this event. But let me get back to your original question first, which is the stagflation issue. So we have, CPI is 4.3%, PPI is minus 1.5%. So companies are getting less and less for their goods and services, and consumers are paying more and more. Basically, this is a two-part problem. It started with the food prices. As you noted, the swine flu was tremendously damaging to China. And then it was greatly compounded by the nationwide shutdown, which cut off domestic supply chains for agriculture and may have medium-term ramifications, because a couple of months ago there were widespread stories of farmers not being able to get seeds that came from across the country to plant their crops. So China's got big-time food problems, which is the big driver of their CPI, which of course hurts the position of the consumer. But at the same time, the goods and services that are coming out of the producer sector are declining in price. So, minus 1.5 PPI is the relevant inflation rate for the manager of an SME who's deciding whether to borrow money so that his business can survive, or alternatively, whether he's going to sell his last, inventory of widgets to somebody outside of China, get the dollars in Hong Kong, and get out of Dodge. So, those are the choices. And the stay in business choice, the math looks like this. You borrow at anywhere from 4.5% to 6, 8%, or maybe double-digit rate if you have to go to the shadow banking sector. And your revenue base, other things equal, is falling in price by 1.5% on average, and your volumes are down because the economy's gotten smoked. And some decent proportion of your workforce didn't return from the village because they were afraid of getting sick. So, this sector it's going pear-shaped, I believe. And, if you look at what the U.S. has done with this payment protection plan, paycheck protection plan, it's got all kinds of problems, but we're throwing hundreds of billions of dollars at our small business sector because whenever we get to the other side of this virus, we want those entities to be able to reemploy a decent portion of the workers they've laid off. If they go out of business, that doesn't happen, and we're going to have a permanent pool of unemployed workers that will need to be on the government dole for an extended period. This is where China's heading. They've done nothing. They've done marginal tax cuts. But when your revenue's collapsing, a VAT cut doesn't do you a heck of a lot of good. And they've tried to arm twist the big banks into lending to smaller companies, which they don't do traditionally, because why make a million loans for a million RMB when you can make 10 loans for 10 billion to SOEs who are government guaranteed? So they're not set up to do the credit work. It's a lousy business for them. And even at the official rate of, say, 4.5% for a one-year loan, the revenues are falling. You can't survive borrowing at that rate. The rest of the world is borrowing at zero. Why hasn't China cut rates? Because their currency will fall out of bed, and it's another pickle they're in. So you hear a lot from Wall Street about stimulus in China. It's complete nonsense. They've done nothing. And they're going to lose a big portion of their SME sector. They're going to lose a big portion of their migrant workforce. 290, 300 million people, a big chunk of those haven't come back. They're going to have to find some other way to sustain themselves, and it's a huge problem for the Chinese system. So, stagflation, and again, to get back to your stagflation question, these people who stay in the village because there's no migrant job for them in the city, and they might get sick in the city, they better grow their own food because food prices are going up 4.5% a year. And again, that could get worse because their ag, system has had this big dislocation. So there's really nothing but problems for the Chinese economy. Just as an aside, I'm personally pretty bullish on U.S. equities here if we can get out of this virus situation in the next few weeks. But at some point in coming months, global asset markets are going to have to deal with the very high likelihood of a dislocation in China's domestic economy and a geopolitical dislocation, frankly. So all kinds of problems coming at global asset markets from China and their incessant can kicking as we approach sort of the end of the wall for them, I think.
There's also videos all over the internet, not sure if you've seen them, of people protesting higher rent prices, that rent prices need to go down for their shops all over China. So I've seen a lot of these videos in just the last 6 weeks.
Yeah, again, the system is not designed, frankly, to give a crap. It's just not set up for anyone to give a crap about that. I hate to say it, but they'll just steamroll those protests. And the answer from the Chinese government will be, you'll get nothing and like it. Okay, that's how they roll. So, the local government stimulus happens through infrastructure projects on which a good chunk of it is skimmed, and the contracts go to, friends and family, basically. It's a huge problem. It's a huge problem. And Xi Jinping tried to address this through his anti-corruption campaign, to which, to some extent has been successful, but it's still a terribly corrupt system, which is not built to care about the people writing about their rent prices. They don't care. And there's no policy infrastructure to address that problem other than bashing heads, basically, unfortunately. I hate to say that, but this is my view of how things work there.
My friend Tony Nash, who lived in Asia for 15 years, he says through his contacts, there's at least 50 million unemployed Chinese factory workers right now. So it's not good. It's a lot of stagflation, a lot of people out of work. And then, like you said, the manufacturers, a lot of these manufacturers are built to export to more affluent consumers in the European Union, the US, and other markets. And the consumer discretionary income in those countries and markets now is just not there until the coronavirus is over with.
Absolutely. And once the dust settles globally in terms of this virus, the supply chain exodus will start again, because China's done themselves no geopolitical favors here. And we know that the opinions in the U.S. have crystallized about being vulnerable to anything that we might have a need for in any kind of national security emergency. It not only cannot be made in China, it can't be connected to China. It can't. And then furthermore, sort of lost in the shuffle of all this virus stuff was the reporting from the Australian think tank, the name escapes me, that was picked up by the U.S. press, about the fact that Nike, Dell, and a bunch of big name companies, it looks like they're using effectively slave labor from Xinjiang in their factories. So again, these are not the kind of things that, we really have a luxury of focusing on right now. But when the smoke clears, I think there's going to be a renewed focus on why we're doing so much business in China, and how some of these companies like Apple, Nike, and others, Starbucks, can position themselves as progressive icons while they're in bed with the Chinese Communist Party. I mean, this is just a dichotomy that I think people are just not going to be able to ignore for much longer. Yeah. So it's problems galore for China, involving the virus, the aftermath of the virus, domestic disequilibrium, about the only thing that could bail them out, and by bail them out, I mean, give them 2 years to fix this problem instead of 6 or 9 months, would be a big decline in the dollar. Doesn't really look all that likely. Anything could happen with foreign exchange. If you get a big decline in the dollar, naturally that brings the pressure off China. They might get some respite if there were a change of government in the U.S. I think Joe Biden's probably more inclined to talk about human rights than actually hit them on economics than Trump might be. But, it doesn't look like China really has a whole lot of friends on either side of the aisle in either the U.S. or Australia or the U.K., where, is Boris Johnson going to bring Huawei into the U.K. 5G network after this virus almost killed him? I'm thinking not. So,
or with add to your point there, or what just happened with Justin Trudeau, how Trudeau sent a cargo plane over to China, and they told him to go pound sand. He wasn't going to get any N95 mask because of Canada's position with Huawei and the Huawei CFO.
Yeah. Absolutely. So there were a lot of countries, the UK, Canada, much of Europe, I would include, who sort of thought they could play both ends against the middle in this U.S.-China spat. Australia's been much more aggressive, sort of more on the U.S. page, but Canada, the UK, Europe have generally thought they could avoid picking a side for an extended period, and sort of have the best of both worlds. I think that it's going to be time to choose much earlier than they thought a few months ago, and much earlier than they would like. And there may be no love lost for Donald Trump in Europe, but they're not picking China.
Yeah, the political winds seem to have changed a lot here in the US. You mentioned both political parties. I mean, it's one of the few things it seems that both political parties agree on is to now try to protect American workers, to try to bring back the supply chain. So do you expect then in the next maybe 2 to 7 years, because obviously with the coronavirus, this is going to delay factories moving back quickly, or either coming to the US or going to Vietnam, India, Bangladesh, some of the other cheaper, Mexico, some of the other cheaper manufacturing areas. But do you expect then a very messy divorce between the US and China economically and what Peter Zeihan would call de-globalization?
Completely, yes, yes. And I think the bigger question is whether that messy divorce morphs into something even messier. So, China has returned to some sort of heavy-handed action in Hong Kong recently. And we could start to see more of that. So, but I think economically it is inevitable. And as much as President Trump might like to bring these jobs back to the U.S., that's not really necessary. There is geopolitical and, in my personal view, sort of moral benefit in having these companies in other third locations rather than China. So I do think that the U.S. derives benefit from supply chain moving from China to Vietnam. It would derive even more benefit if it moves to Mexico, which we have closer economic ties with, and would get ancillary benefits from Mexico doing better. So the jobs don't have to come back to the U.S. But I look at this on so it's 2 to 7 years. So let's say 7 to 10 years. Either the Chinese Communist Party is going to be running China or it's not. And I don't think the markets really are going to like either one of those outcomes, right? Because if they're not, obviously something crazy has happened. Now, I think that would be the better thing for the world. The Communist Party of China walked away and we had some kind of federal democratic system or some other construction in China where those 1.3 billion individuals had some semblance of political rights and say in their governance, right? That would be a good thing. Obviously, getting from here to there is going to be incredibly destabilizing. But I think that's the path we should be on, frankly, because the alternative is that 10 years from now, the largest economy in the world is run by people who don't like anyone to have political rights. And they will inevitably, spread that ethos as far as they can. It's just not tenable in my view. And the idea that we can have some, peaceful, bipolar cooperation between that regime and the West, I don't buy it. It's not my view. Well, so, the divorce is going to happen. You said 2 to 7 years, right? Like, who knows what the timeline is or what path this takes. Wow. There are going to be a lot of zigs and zags, depending on what we find out about where this virus originated, depending on how the U.S. election goes, depending on the rate at which the global economy comes back, depending on whether the dollar goes up or down, depending on, whether China dislocates. So China itself, going back to all these disequilibria I talked about, and their penchant for just rigging the market rather than letting it clear to a new equilibrium, as this pertains to their capital account, it leads them on a path of closure. Like they financially, they are having to close themselves off from the rest of the world. It plays right into the U.S. desire to decouple, that China is willing to cut itself off from foreign exchange, from the oxygen of of global finance, basically. So China itself may decide that, their best strategy is to go retreat for 15 years and see if the West, blows itself up with, capitalist decadence or something. So it's not that far-fetched that the decoupling is sort of two-sided, but this leads to some potential messy geopolitics as well, because in the world where China says, we're going to retreat and put up a wall and be our own entity for 15 years, and then we'll come back and try this global domination thing again, in that scenario, they're taking Hong Kong and Taiwan with them behind that wall. I think, and they would have to, I would imagine. So, we're sort of down the rabbit hole here. But these things on the time frame you talked about, all of these possibilities are in play. And this situation with this virus has obviously brought all kinds of tales into play and accelerated the timeline of everything we're discussing here.
Yes, expose the holes in the global supply chain, how too much manufacturing was concentrated on China.
Absolutely.
I also think for the 2-year that I mentioned, I don't think a lot of factories will leave in only 2 years. I think it'll start where more factories will start to leave in 2 years. So these things normally take more time, especially with all the rules and regulations here in the US and trying to get like tax rebates, like with what Foxconn got in Wisconsin. So I don't think a lot of the US is going to get an enormous amount of factories. They will get some, but a lot of them are going to be automated though.
Right. But then the question is, if China believes they really see the writing on the wall, then do they force that timeline somehow?
We'll have to see.
I mean, does their approach to Hong Kong, to Taiwan, to their capital account, to the Belt and Road, does their approach to everything change if they come to the determination that they're definitely being decoupled? It probably does.
We will definitely have to have you back on. This was an incredible interview, Brian. There is a lot of good insights in here. Some of my listeners are going to have to listen to this 2 or 3 times. I'm probably going to have to listen to this again too. Just amazing insights there. Thank you so much for your time, Brian. If my listeners want to follow
I really appreciate the opportunity to be on. Thank you very much.
If my listeners want to follow more of your work, how do they do so?
Sure. Check out my website at macrolens.com, and you can contact me there. My email and all my contact details are there. MacroLens is a third-party research firm specializing in global macro strategy with an emphasis on China and its interplay with the U.S. and the rest of the world. So pretty much everything we discussed, I'd be happy to chat with any of your listeners who want to learn more.